A company can have millions in assets and still be in serious financial trouble. Why? Because assets are only one side of the picture. We also need to understand how those assets are financed. Think of the balance sheet as a financial photograph at a specific date. It asks what the company owns, what it owes, and what remains for the owners. The fundamental accounting equation is simple. Assets equal liabilities plus equity. This equation must always balance. Let us break down each part. Assets are resources controlled by the company that should provide future economic benefits. In simple terms, assets are what the company owns or controls that have value. Imagine cash of $100,000, receivables of $50,000, inventory of $70,000, and equipment of $80,000. Together, total assets equal $300,000. Does having $300,000 in assets mean the company is financially strong? Not necessarily. Some assets may be difficult to collect, slow to sell, or dependent on debt financing. We must also examine the liabilities. Liabilities are obligations owed to other parties. They represent what the company must pay or settle, including bank loans, supplier balances, salaries, taxes, VAT, and other obligations. Suppose the company owes suppliers $60,000, has a bank loan of $140,000, and owes $20,000 in taxes. Total liabilities are $220,000. Equity equals assets minus liabilities. So $300,000 in assets minus $220,000 in liabilities equals $80,000. This is the owner's residual interest after all obligations are deducted. Professionals look deeper than total assets. They ask about debt, short-term liquidity, collectible receivables, saleable inventory, and whether assets generate sufficient returns. Assets may look impressive, but if they cannot generate cash or are financed by excessive liabilities, financial pressure can follow. The balance sheet tells a story about structure and business health. A company may report significant assets, but if those assets cannot generate cash, cannot be recovered, or are financed by excessive liabilities, the company may face serious financial pressure. That is why financial health depends on more than the size of the asset total. Remember the equation. Assets show what the company owns, liabilities show what it owes, and equity shows the owner's remaining interest. A strong balance sheet is not simply about more assets. It requires quality assets, manageable liabilities, sufficient liquidity, and a sustainable structure. Follow Dogger Audit for practical accounting, audit, finance, IFRS, and financial analysis explanations.